Today we're going to talk about volatility in the marketplace. We're experiencing a lot of volatility in the stock market these days. A lot of it is due to some political agendas and things like that. But understand that most of the volatility is not really tied to real issues. It's tied to fear and headlines and people's reaction to those things. When we talk about the cycle of investor emotions, it's important to understand that Warren Buffett said it best when he said, it's important to be fearful when others are greedy and greedy when others are fearful. But the problem is the average investor allows their emotions to take control of their decision-making process. And so in times when the market is on the rise, unfortunately, we're usually too late to get excited and confident about the market. And what happens is we end up buying at the top of the market. And unfortunately, when the market starts to turn, we talk about it's going to come back, it's going to be okay. And then we start to get scared, maybe even panic and despair. And unfortunately, we don't typically end up exiting at the right time. We tend to exit at the downturn of the market, which means instead of the obvious trying to buy low and sell high, we end up buying high and selling low. And this is why most self-directed investors struggle to make money. Using an advisor, we can coach you through the fact that when the market is down, that's an opportunity to get the market on sale. And where the market is at an all-time high, it might be the time to be a little cautious. This particular slide is interesting. And what it shows is that for somebody who had invested $10,000 back in 1986, nearly 40 years ago, and if they had kept their investment in the market without making any changes for 35 years, they would actually, if they'd stayed fully invested that entire time, would have $150,000 in the market. If they allowed their emotions to affect their decision-making and had actually selected to move out of the market when the market dropped, out of fear or panicking, they would have probably missed the 10 best days in the market. And if you missed the 10 best days in the market over that 35-year time frame, you would have lost about 65% of your growth opportunity. And if you had missed 15 days, it would be even more impactful. And if you had missed just 20 days out of the 35-year time frame, you would have done 1/6 of the growth as you would have if you just stayed fully invested. So this particular slide shows the results of the 2008 market crash, and it's a case study showing the 4 different options that somebody might have implemented and how that would have resulted. If you look here, what this shows is somebody who had $100,000 invested in the market at the beginning of 2008, and where it dropped to the bottom of this market retraction, they would have lost about $45,000 in that time frame. And what this slide really shows you is, depending on the way you handled this situation, we have everything from somebody who sold all of their investment assets and waited a year to get back into the market, to somebody who added $100 a month as a regular contribution, dollar cost averaging back into the market on top of their original investment. We show somebody who invested a $10,000 lump sum at the bottom of that market retraction, and we show somebody who just stayed the course. And what happens in each one of those scenarios is we get a different number of months to recovery. What that shows us is somebody who added $10,000 as a lump sum at the bottom of the market performed the best. They actually fully recovered their investment within 18 months. Somebody who added $100 per month contribution to their investment plan recovered within 23 months. Somebody who just stayed the course and took no action at all was able to fully recover within 25 months. But somebody who exited the market in an attempt to preserve their capital would have missed most of the recovery and unfortunately would have taken 105 months to recover their investment. And this last slide really just talks about somebody who was regularly contributing, in this case $400 a month in the US stock market, the S&P 500, since 1982. You would have experienced 6 recessions, 5 bear markets, 41 Fed rate hikes, a dot-com bubble, Black Monday, 2 50+% crashes, 12 US involved wars, a global pandemic, impeached presidents, and the 2008 financial crisis. And in that time, you would have invested $192,000 of your own money and had $4 million of growth to show for it. So This shows the importance of staying with the market and the power of the growth of the market over time, regardless of the current economic conditions. Now, depending on where you're at in your timeline, if you're somebody who's entering retirement, our advice might be a little bit different for you. But if you're somebody who has a long time horizon, this shows the significance of staying invested, and not only staying invested, possibly continuing to increase your investment into the market when the market is on sale. If you're experiencing anxiousness and nervousness about the market condition, and you're interested in speaking to a professional advisor about what you can do to help secure your financial future in this volatile market, please reach out to us, SpectreFinancial.ca. We'd be happy to help.